Welcome to Investors Insights. Our topic today, don't panic. I'm joined by my distinguished colleagues. We've just come out of a meeting that was intense with a lot of research and insight. I very seldom say this, but grab a pen and paper, grab your laptop and do a little typing. There's a lot of data in this vlog, and I want to encourage each and every one of you to watch it to the end, because this has a lot to do not only with the tariffs, but the rippling effect of what's taking place and how it relates to your financial blueprint and your portfolio. I think it'll be well worth your time to take some notes on the data we present, as well as from the standpoint that you can use later in reference as we continue through the week. So, Bobby, I would like to start off with you because you talked about the volatility in the market and you had some historical information that can be applied here.
Yeah, obviously, it's an important point to make that currently the market pullback we're experiencing is a market and policy event, not a financial or credit event. There's a difference. And so looking at these charts on the left, you can see all the policy uncertainty index spikes going back to 1985. And the chart on the right showing the S&P 500 returns following spikes in U.S. policy uncertainty. So the chart shows that in the following 1, 3, 6, and 12-month time periods following policy uncertainty spikes, that the market historically recovers even with the larger pullbacks seen in the last 40 years. So the point is, as concerning as last week's market pullback was, and with the uncertainty spike, we have been here before. And I also want to share a chart that we review each week that gives us an insight into the U.S. economic health. And I've highlighted the change in non-farm payrolls increasing from March that we got last week. Now, it's important to point out that this strong number doesn't include the impact of the tariffs announced this last week, but it's great to see a strong employment environment as we deal with the potential impact of tariffs. So we'll continue to keep everyone updated on the data points and obviously the economic health because of the tariff announcements.
Yeah, very much so. And as we were talking earlier in the meeting today, I've been doing this 44 years. And in those 44 years, there's been a lot of cycles like this. And clients that have been with me through all of that, as well as those that have been with us in our 20 years at Five Plan Partners, we've seen downturns. In 2000, we had the tech bubble. In 2008, we had the great financial crisis. In 2020, we had the COVID pandemic crash. And in 2022, we had the Fed rate hike panic. That's just a sample of what's taking place. And through each of those, we were there for our clients, and we're here to answer your questions if you have concerns. Let me say this, Trey. I really appreciated your data in relation to what Bobby shared today. Both of you not knowing what each other was coming in the room with to debate and discuss. I thought it was it was great how all that came together. So talk about referencing past experiences, past markets that we've had to deal with.
Yeah, thanks, Greg. Bobby had a great point that this is separating market events from economic events and financial events. And so currently, we feel like this is a market event. And Warren Buffett has a great quote that in the short run, the market is a voting machine. In the long run, it's a weighing machine. So what does that mean? In the short run, when you see the market is up or down, if it's down, it's because there's more sellers today than buyers. That's pretty much all that it means. And if it's up, it's usually because there's more buyers than sellers. So that's the market voting day in, day out. But over time, the weight of the evidence and fundamentals tend to drive prices. And so what does that mean for us now? Well, what it means for us is let's look at historical precedents. Why do we look back? Why was Greg referencing those time periods? Because history doesn't repeat itself, but it often rhymes. And why does it rhyme? And it's because mankind, humans we're the ones that are pushing the market around. And so we have the same emotional foibles that we have in history repeats itself. And so let's look back at past market events. I'll go in order here, and you can see on these charts. Let's start with 2018. Very similar to today, a tariff event and a Fed being offsides on rates being too high. The S&P dropped 19.8%, but then quickly recovered a few months after that. You can see that spike down and then the quick recovery. Why? Because we didn't go into an economic event or recession. Similarly, in 2015, 2016, there was fear of China slowdown, and again, Fed raising rates. We saw a 15% drop in this scenario, but again, and there were multiple drops here, but again, a quick recovery because we never expanded into recession. Looking back in 2011, the European debt crisis, and then the U.S. credit was downgraded for the first time in history from AAA. The markets dropped over 19%, but again, a quick recovery. And this is the most surprising because in this situation, Europe, the second largest trading bloc in the world, did go into recession, but the U.S. remained resilient and our markets quickly recovered. Then the last one I'll show is 1998, the Asian financial crisis and the collapse of long-term capital management. You can see again, similar 19% pullback, but again, a quick recovery because it was a market event and not an economic event. 1998, when many people think back to the late 90s, they think of booming tech prices, stock market doubling every couple of years. It's almost forgotten that in 1998, we had this large pullback. And that's because the market recovered and it did not extend into any kind of economic pullback. The 2000 and 2001 economic pullback was something completely separate from this. So all this to point out that this time may feel different. The calls may feel slightly different, but there's a lot of historical precedent for market events like this. And that's why it's good to sit back, look at where we are today and view, is this a economic event or is this a buying opportunity potentially where we could see prices move higher? And that's something we're watching very closely.
Trey, you're absolutely correct. We're watching it very closely, and I really appreciate all the data you put together. And also, you made a great point when you said, people don't remember what took place in 1998. Well, those of us that are in the industry, and especially here at Five Plan Partners, we lock in very much to historical data, and especially when we experienced it, when we were in the middle of it. And so we reference these things to know, hey, we've seen this before. What was the outcomes? And we're going to continue bringing that kind of information and insight to our clients as compared to listening to the news media. I was listening early this morning to some of the things being said on TV while doing additional research and talking to clients. And I was just amazed at how they created anxiety just on that one particular show. Don't listen to that. If you got questions and need answers, give us a call. We're here. We're going to be contacting our clients as well. And Ty, you're a confirmation that we try to look ahead. All three of you are in terms of these vlogs. But Ty, you've been focused on tariffs. You've talked about the tariffs through so far through this year. Bring us up to date on the research you're seeing there.
Yeah. So, as you mentioned, we've spoken about tariffs for, seems like going on about a month now consecutively.
But there's a reason.
Right. Absolutely. I mean,
we're here now.
That's the big, kind of market mover. That's what everyone was waiting on. And we finally reached that all important date last week of I believe it was April 2nd. Now we have some clarity. The clarity is baseline 10% tariff on all imported goods effective as of April 5th. Roughly 60 countries will be subject to tariffs above 10%. That'll be effective as of April 9th. Existing tariffs that were already in place will remain in place, such as China and autos. Mexico and Canada got a good break. They're not subject to new tariffs, but the existing 25% tariff on non-USMCA compliant goods does remain in place. Products related to commodity and sectoral tariffs got exempted from additional tariffs, so that saved $100 billion right there. Could have been a lot more. And China is facing right now a 79% tariff rate. And if President Trump goes through with additional tariffs on countries that are purchasing Venezuelan oil, it could be 100% or more. So that's kind of the baseline. Again, that's what that translates to is $470 billion of additional tariffs on top of the 150 that were already in place. So about $620 billion of tariffs, which is about 2% of our GDP. And would equal the biggest tax increase as a percentage of GDP ever. So again, those are the headlines you're going to see. So what are we, looking at going forward? How do we classify things? And what was some actual maybe good news that came of this? Well, first, we think of it in 5 separate buckets. So as you can see in this chart, we have China, They're kind of on their own. Seems like there's not going to be a lot of ongoing negotiation there. Seems like the decoupling of China is going to remain a theme. Then you have the USMCA. Again, Mexico and Canada were kind of surprisingly left out of additional tariffs, which is good news. Hopefully, we can have some ongoing negotiations with those two countries as they are, of course, our closest allies border-wise, location-wise. Then in the third bucket, you have reciprocal tariffs. That's essentially the tariffs that the U.S. may be charging countries that were already charging us. That's where negotiations can be had. So that's where you'll see a lot of stuff in the news, I'm sure, of Vietnam lowered their tariff rate on the U.S. to 0%. How does the U.S. kind of combat that? Things like that. Sectoral tariffs, we think they kind of were exempted right now, but are still on the table moving forward. That's pharmacy, for drugs. That could be autos again. That could be chips. That can be any kind of sectoral tariffs, just a particular industry. And then that fifth bucket is commodities, so steel, lumber, things like that. And again, for right now, that was kind of exempted, but that's something we're going to keep an eye on moving forward to see if that takes place. So those are kind of the 5 buckets. What are we looking for going forward? Negotiation and retaliation from other countries, whether that be tariffs or non-economic related, negotiations or retaliations. Central bank responses across the world, not just in the U.S. I'm sure everyone's already seen President Trump, tweeting out that J-Pow needs to lower rates. I don't think we're really in that camp right now, but that's going to be some ongoing negotiations as well. And there's going to be a lot of pressure that you're going to see in the news from Trump putting on central banks. You'll have, of course, fiscal policy. So Congress is finally making some ground, hopefully, on starting this tax bill discussion. What would a tax bill look like? I guess first, what happened when Trump was president the first time, we had TCJA and then we had tariffs. So it was easier to stomach. This time we have tariffs and now we're having tax negotiations. So we need to see some kind of action before Memorial Day would be nice. Have something in place. But what would that tax bill look like? Could be a corporate tax cut and a personal, income tax cut. How would that be done? Well, one way is to talk about deductions for CapEx of 100%, hopefully retroactive to January 1. Some of it could look like an accelerated depreciation schedule. So a lot of this stuff, we have the $620 billion number right now, can be kind of moved back in if we get those tax cuts. Again, it's all in real time. We're going to keep getting news throughout, but we'll keep an eye on it for you.
And Ty, I really like the way you did the buckets, the 5 buckets. I think that puts it in perspective. The news media has really focused on the total dollar amount of 600 billion plus. And in reality, we need to break it up and look at the different sections. And folks, we're going to continue to do that for you so you can understand what this occurs or this occurs. What's the rippling effect on those tariffs? So I thought you did a great job on that. The other thing to be aware of, as Ty has talked about, is from the standpoint of the tax cuts. This puts pressure on Congress in regards to moving forward on tax cuts. We'll see if they do it. The next 5 to 6 weeks will be very, very important. And so we'll keep you updated on that as well. So with that said, just know we're here. Just know we're staying on top of it. We will continue to send you these vlogs. We're available to have one-on-one conversations. Our podcast, our YouTube, LinkedIn, Twitter, Facebook. We put out information on an ongoing basis. And so we want you to have confidence not only about your financial blueprint and also about your portfolio, but also when you're having conversation with people and people throw out some outrageous data that you can go, no, that's really not the facts, because there's a lot of fake news going on out there. We continue to tell you that this is the attention economy, and a lot of people are trying to capture your attention. And one way they do it is if they can emotionally stir you up or create anxiety and fear. Don't let that happen. Don't panic. We thank you for entrusting us here at Five Plan Partners, and know that each and every day And especially in these circumstances we're in right now, we're here striving to give our clients a better, richer, fuller life. Have a great week, and we're going to keep you updated. Thanks.